Ladies and gentlemen, welcome to Cummins India Limited Q1 FY2023-24 earnings conference call. We hope you are all keeping safe and healthy. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. I will now hand over to Mr. Ashwath Ram, MD, Cummins India Limited. Thank you, and over to you, sir.
Good morning, ladies and gentlemen. Welcome to the Cummins India Limited Q1 FY24 earnings conference call. My name is Ashwath Ram, and I am the Managing Director of Cummins India Limited. Joining me on the call today is Ajay Patil, Chief Financial Officer of Cummins India Limited. Thank you all for joining us on this call today. I am really happy to inform you that the company successfully launched products duly certified to meet the new CPCB 4+ emission norms in the powergen segment and is fully prepared to deliver the best-in-class products to power the success of our customers. Backed by our brand promise of innovation and dependability, we are confident that these products will continue to deliver superior performance. Now I would like to share an update on our Q1 FY24 financial results. I am pleased to announce that CIL reported record revenue for the quarter, driven by strong domestic demand. The export revenue is at levels similar to the previous quarter. Getting into the financial results, for the quarter ended June 30, 2023, with respect to the same quarter last year, our sales at rupees 2,175 crore are higher by 31% compared to rupees 1,657 crore recorded in the same quarter last year. Domestic sales at rupees 1,677 crore are higher by 43%. Exports at rupees 498 crore are higher by 3%. Profit before tax at rupees 415 crore is higher by 57% compared to the same quarter last year. For the quarter ended June 30, 2023, with respect to last quarter, our sales at rupees 2,175 crore are higher by 15% compared to rupees 1,889 crore recorded in the last quarter. Domestic sales at rupees 1,677 crore are higher by 20%. Exports at rupees 498 crore are higher by 1%. Profit before tax at rupees 415 crore is flat compared to the previous quarter. I would now like to share the segment-wise sales breakup for the quarter ended June 30th, 2023. Domestic. Power generation domestic sales were rupees 873 crore, a 76% increase over last year and 30% increase over the last quarter. Distribution business sales were rupees 534 crore, 28% increase over last year and 11% increase over last quarter. Industrial domestic business sales were rupees 236 crore, flat versus last year and 9% increase over last quarter. Exports. High horsepower exports were rupees 244 crore, 5% increase over last year and 18% increase over last quarter. LSP exports were rupees 201 crore, flat versus last year and 17% decrease over last quarter. Cummins India financial guidance. Regarding the sales outlook for the full year 2023-24, we look forward to continuing our double-digit growth over the fiscal year 2022-23. I now open the session for questions. Thank you.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to withdraw yourself from the question queue, you may press star and 2. Participants are requested to use only handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We have our first question from the line of Parikshit Kandpal from HDFC Securities. Please go ahead.
Yeah, hi Ashwath. Congratulations on a great quarter, sir. So my first question is on CPCB 4 Plus implementation. So now it's all done and dusted. So how do you see the channel demand right now? Do you think any significant decline in the volumes for the rest of the year? And do you think that it can be made up, more than made up by the increase in prices so that we can maintain that 2x nominal GDP growth which we aspire to have every year?
Sure, Parikshit, thank you. That's a very good question. CPCB 4 Plus has been launched. It's been launched very well, and we feel very comfortable with our position in the market from where we stand as compared to where competition is from a product perspective. What the government at the last minute has announced is that CPCB gensets can be produced and sold all the way up to June 2024. In effect, only certain areas and certain market segments will move to CPCB 4 Plus, and we are still trying to ascertain how that mix and how that spread is. And that puts us in, we were expecting a very smooth product A to product B transition, but now for the next 1 year, we are going to have to work with both the ranges of products being sold simultaneously. So while we feel good about where the market is, good about our position in the market, there is a lot of uncertainty about how the transition, what percentage of the market will transition over the next couple of quarters, and that's where we find ourselves right now.
Okay, so you're saying both CPCB 2 and 4 Plus, so both the products will be there available for sales even for the rest of the year till June 24.
That's correct. But at least the good part is that it's all announced, the guidelines are in place, everything has been tested, everything has been launched, pricing has been announced. So, we feel that, all the uncertainty from the development and launch of the products, all of that has gone away. It's now market adoption, which we will get more and more clarity as we move forward.
Okay. My second question is on the AGM presentation. I think the first time you have put out something on the hydrogen. So you've mentioned about fuel cells on railways and battery energy storage systems for other applications. So is there now clarity what CTL will do in terms of hydrogen and what CIL will do? So if you can help us understand. So what will be the roadmap for a hydrogen story for both these entities in India?
Yeah, there has always been clarity that the market segments that are served by CIL will continue to get served by CIL. So whether it's batteries or whether it's hydrogen or whether it's any other kind of fuel, the segments which are already being served will continue to get served. What is still not 100% clear to us is the best path to enter into the production of hydrogen, and that is what is being worked out. The strategy for that is being worked out, and the company is, been talking to various consultants and trying to figure out what is that entry strategy. But getting into rail or getting into expanding the scope of our power gen services to also include battery and energy storage systems, getting into construction and running hydrogen internal combustion engines in construction markets. I think all of those kinds of decisions are clear for the company, and we are moving forward aggressively on that.
Okay. And just the last question, sir, on the margin. So we have seen slight decline in the gross margins, and also there has been an increase on other expenses and employee cost. Just wanted your stance in terms of margin trajectory. I think where we had seen that every year there could be a pathway of 100 basis point improvement in margin. So how do we stand there? And also if there was any one-off this quarter, any low margin, data center, large lumpy data center order, which could have resulted in slightly lower margin.
Yeah. So actually, margins have improved as compared to the previous year. So our guidance of attempting to improve margin by 100 basis points, it holds true. When you compare from a quarter-on-quarter basis, we have some one-time kind of expenses on the cost side related to timing of where we did increments for employees, where we moved that forward by about a quarter. So some of those kinds of variables, as well as some one-timers in warranty, etc., those led to sequential quarter slight reduction in margin. But overall, we feel good that our attempt to keep improving margin year on year holds true. There's a lot of focus on cost, and so I feel confident that we are on the right path as far as margins are concerned.
Okay. Thank you, sir. Thank you, and all the best.
Thank you. We have our next question from the line of Mohit Kumar from ICICI Securities. Please go ahead.
Good morning, sir, and congratulations on excellent set of numbers.
Thank you.
My first question is, sir, I understand that you're allowed to sell up to June 24 if you have the purchase order received till June 23. How was that purchase? Can you just broadly indicate the activity or let's say purchase order quantum received for the older set till June 23 and which are still pending to be supplied in the rest of the year?
So we have received a very, very full order board which has demand all the way up to June 2024. So I don't think we are worried from an order perspective. I think the bigger concern for us is that there will be many markets which will also begin the transition to CPCB 4 Plus without waiting for June. And how do we balance out the right mix and work with two sets of product lines in parallel? Those are the kinds of things the teams are working on and figuring out how to optimize both the supply chains, because both will have to be, one will have to be kept alive and the other one will have to be scaled up. But order boards are full.
My second question is, how does the new CPCB4 engines, what is the pricing difference now? As of course, you rolled out the pricing, you must be more aware of the pricing now. So can you please indicate the broad pricing difference? And the related question is, how do you see this opening this export market for us?
Right. So the pricing is in a range. It's not, we can say on an average it's somewhere between 20 to 50% is the range in which prices have gone up. So I won't tell you exactly what the average is, because it's irrelevant, because the volumes are different at different nodes. But certainly prices have gone up significantly. And we find that we will be very competitive even with that kind of with that kind of price increase. The second portion of your question was, what does that mean to access other markets? And certainly it's good news for us that these products are developed. The products of CPCB 4 Plus are the tightest emission products in the world as far as these markets are concerned. And so we are working on reconfiguring some of these products for use in other markets around the world. So the configuration for India can't just be taken one-to-one and just sold in markets, especially in markets in North America, because the markets in India work on a 50 hertz electrical cycle, whereas the markets in the United States work on a 60 hertz electrical cycle. So the engine pretty much works at a different RPM. So, but the teams are working on trying to make those kinds of conversions, and also trying to figure out which are the market segments globally where we can launch some of these products in the near future.
Understood, sir. Thank you and all the best, sir. Thank you.
Thank you. We have a next question from the line of Ravi Swaminathan from Avendus Spark. Please go ahead.
Sir, congrats on a good set of numbers, and thanks a lot for taking my question. My first question is with respect to the power gen segment. This quarter there would have been a lot of pre-buy price increase, which had led to close to 76% kind of growth. But what is the underlying volume growth that one should roughly anticipate in the power gen side over the next few quarters or a couple of years? And what are the drivers of that?
Right. So, yes, you are absolutely right. I would say that pre-buy led to a very, very strong domestic quarter for the power gen business. Moving forward, typically when so much of a pre-buy happens in any cycle, the subsequent quarter sees slightly less demand, and so we anticipate that similar kind of situation to happen here. That's a very short-term phenomenon. The long-term, our estimate of this market is we expect it to grow at roughly 2x of GDP. And the reason being that as markets become more mature and more dependent on power, the power consumption and their sensitivity to not having 100% reliable grid power actually increases. And we have seen this trend in multiple markets around the world. So we think that the power gen market in India will continue to grow aggressively over at least for the next 8 to 10 years, especially because a big chunk of power gen also goes into infrastructure. And so if India is to become first a 6 trillion economy and then a 10 trillion economy over the next 10 years, the use of gensets and power gen equipment and industrial and construction equipment is going to keep increasing. And that is a very good sign for us from an India perspective. So short term, very, very short term, slightly, flattish kind of indication. Long term, very bullish and optimistic that things will be good for this business.
Got it, sir. And my second question is with respect to exports. After multiple quarters of very strong growth, we have seen exports kind of be seeing moderate or mild growth. Is it something that this quarter is kind of an aberration, nothing too much to read on it? Growth can chug along, overall market level demand and company level efforts that you can comment upon?
Yeah, so what we are seeing is that certain areas of the world have started to slow down quite significantly. We are especially starting to see slowing happening in Europe pretty significantly. In Africa is flat. Asia Pacific and Latin America have also started to slow down a little bit. I think part of it is to do with the China bounce back not happening as well as was anticipated. And so the combination of all of these things is that it appears some parts of the power gen market are flattening out. Now, what we are trying to do to overcome that is to try to figure out, can we launch, we have launched a lot of new products, can we launch more products, can we be more aggressive using our better cost base in India to try to get more market share. So the attempt that we are going to do is to say, can we get market share even in a declining market? So the news from the market is that the market is flattening, and in certain parts of the world it is starting to decline a bit. Whether a couple of quarters down the line, whether that will flatten out and again start to grow is something we are waiting and watching. So I can't predict that well. But what we can do, what is in our control, is to say that despite those markets slowing down, can we still increase our market share by being more aggressive, as well as by introducing more products. So that's going to be our attempt to try to maintain the export performance.
Got it, sir. And my last question is with respect to the distribution business. This is a derivative of the growth, or the demand should come from the power gen or industrial side. What is driving the growth in the distribution business? We continue to grow at a robust pace.
I think you already answered your own question. As the power generation business is growing, as the industrial construction business is growing, as infrastructure is being built, people are using equipment. So when they use equipment, it needs to be serviced. Our products we are offering longer and more better maintenance packages. So historically, after warranty cycles were over, people used to be able to go out of fold and be able to use roadside mechanics or small service centers to repair their products, use aftermarket parts not bought from Cummins. But as the products are getting more complicated, as electronics is entering into these products, we are also offering more comprehensive longer-term packages by which customers remain in fold and they buy our genuine parts, etc. That, and of course trying to enter into new market segments, provide more services, more options, more parts, more kits. Combination of all of these activities is what is leading to the growth. We still feel that where we are today in terms of our penetration of distribution business is lower than what we have seen in our own company in other parts of the world, and so our entitlement is higher. So we still think there is a lot of growth opportunity available in this space in the future.
Got it, sir. Thanks.
Thank you. We have a next question from the line of Deepak from HDFC Pension. Please go ahead. Mr. Deepak, please go ahead with your question. Since there is no response, we'll move on to the next question from the line of Rushabh Shah from O3 Securities. Please go ahead.
Hi, sir. Am I audible?
Sir, can you use your handset, please? You're not clear.
Am I audible now?
Yes, please go ahead.
Yeah. So congratulations on a great quarter. Sir, I have a question on hydrogen. Since hydrogen is a very flammable gas.
Mr. Shah, I'm sorry, but you're not clear, sir. Are you using your handset mode?
Yeah. Am I audible? Am I clear now?
Yes.
Yeah. So, since hydrogen is very flammable, does any technology has been discovered so that hydrogen can be used safely for short or long distances?
Yes. So to answer that question, hydrogen is now being used for many years now. People still have memories of the historical failures of hydrogen, but over the last 40 or 50 years, significant improvements have been made in making hydrogen safer to use in terms of the storage mechanisms, the fuel delivery systems, the combustion process itself, leak detection, and escape and routing mechanisms. So the answer is today's hydrogen designs are, I would say, on par with the most other combustible fuels like LNG, CNG, etc. So, I would say the safety has come a long way. Of course, there's a cost to that safety. These systems tend to be a lot more expensive, and they are still not produced in the scale that is required for the cost to come down. But the safety question is more or less now under control.
Okay. And my second question is, Sir, how might the shift in electrification be affected? How might the shift in electrification affect the market share of Cummins in engines? Because electrification is happening at a faster pace or slower pace. How will the market share be affected of Cummins?
Right. So I think we are all trying to figure out what that right balance is. It is Cummins' view, based on many studies that we have conducted, that it is going to be different for different markets. So let's look at the markets in which CIL plays, which is mainly in the power generation and let's say the industrial markets. In the power generation markets, we feel that over the next 5 to 10 years, everything below 25 kilowatts could go towards batteries. It's not going to go towards any other fuel. About 25 kilowatts, it is still diesel and other fuels, including LNG, CNG, etc. Still have a very, very long way to go before battery technology can be cost effective to meet some of those kinds of requirements, and Cummins is exploring all of those options. In the industrial and construction market, we feel that it will be a gradual path. It will first move from diesel over the next, up to the end of this decade, we actually see demand for diesel going up before it starts to plateau out and then gradually decline starting in the 2040s time frame. And during that time, different technologies like LNG, CNG, hydrogen internal combustion engines, etc. will start to gain more ground, and gradually the shift could happen to hydrogen in that space. The lowest end of the construction vehicle, which is sub 50 horsepower, those are the areas which could go in the electric mobility route, but mainly for areas where there is limited use scenarios. So that's the way we are looking at it right now, and Cummins is already making investments in many of those areas and has a plan to become a carbon neutral company by 2050. India, as you know, will become carbon neutral by 2070. So the migration path for India is even longer than what it is going to be for other parts of the world.
Okay, thank you, sir. And one last question is, going ahead, what kind of headwinds can be seen for Cummins in such an inflationary environment?
I don't see too many headwinds. I think this is a very exciting time from a Cummins perspective. The biggest headwind is ourselves internally in how well we can execute on some of the projects that we have undertaken. But when I look at macroeconomic factors, I think that India is growing, that India will continue to grow, that infrastructure will continue to grow, that power requirements will continue to grow, that technology will be needed to move into cleaner emissions and electrification, and having all of those are areas where Cummins plays in, and so I don't see those as challenges. The challenge will be how well we execute on introducing some of the technologies, how well we localize, how well we invest within the country, and how well we scale up and build on the technology that Cummins is developing worldwide.
Okay, sir. Thank you so much. I'll join back in queue.
Thank you. We have our next question from the line of Deepak Krishnan from Macquarie. Please go ahead.
Hi, sir. Thank you for the opportunity. I just wanted to check, essentially, because we now have an order book full for CPCB2 for the full year. Is CPCB4 implementation virtually sort of not expected? But I just wanted to understand, why would customers pick up a product that is 25% higher in cost, and does that give competition an edge, that they know your pricing and sort of can catch up with you over the 1 year period?
I think first of all, the development cycle for CPCB4 was a very, very expensive and very complicated cycle. So just by looking at pricing, one can't catch up to technology. So I'll put that question aside. But where CPCB CPCB 4 Plus is already getting adopted is there are many cities like in the National Capital Region where CPCB 2 gensets were not being allowed to be run in many months of the year. And there's notification to say that they had to retrofit devices, emission control devices, to make them suitable to work. Now, the cost of a retrofit device on a CPCB 2 engine is higher than the cost of a CPCB 4 Plus engine genset. So many of those markets will directly move to CPCB 4 Plus. The product is better, the efficiency is better, the footprint is better, and they are actually certified and qualified to work in those markets. And also anyone going in for new purchases, not everyone is just worried about the initial capital cost. If you look at the long-term requirements, I think there are certain companies or certain types of markets which just want the best product in a segment, and we see some of those markets also going there. We are not able to exactly predict what that means in the percentage of the overall mix, but we think it is likely to be greater than 25% is what our current estimate is as of now.
Sure, sir. Maybe just one follow-up. The employee expense, I just wanted to understand, given that we've taken the price, we've given the employee hikes, this would sort of be the run rate bills that we would look at for quarters ahead. Is that understanding correct?
Could you repeat it? Sorry, I couldn't hear you very clearly, the last portion of what you said.
Yeah, the employee expense, now that we've undertaken the pay revision, this would be sort of the run rate that we look at going ahead. Is that understanding correct?
Yeah, that is correct.
Sure, sir. So those were my questions, and thank you for the opportunity.
Thank you. We have our next question from the line of Gokul Maheshwari from Aurika Capital. Please go ahead.
Yeah, just wanted to clarify one thing. The extension of June 24 allows you to manufacture as well as manufacturing and sale of CPCB 2 machines.
That's correct.
Okay. Second thing is on the JV income. If you could just highlight in the last 2 or 3 quarters or in the last 12 months, there has been a substantial increase. How sustainable is this? And if you could comment that what is leading to such strong growth over there?
Right. I think you're talking about the 2 JVs. One is our alternator JV, and the second one is the Valvoline JV. And the alternator JV is doing well because it is directly proportional to the power generation business. So as the power generation business is doing well, the alternator business is also doing well. So its results, from a predictability perspective, are very similar to the results which overall the power gen business, comes out with. As far as the Valvoline business is concerned, that's mainly an aftermarket kind of business, and that business gets severely impacted by the cost of oil and many such variables. So those both are, good and great companies. So we expect that these businesses will continue to do well, but we don't expect them to do disproportionately well as compared to the rest of the company.
Okay, thank you. Second thing is on you in the past have been mentioning that you've been able to cater to out of 185% of the demand. How's the supply situation now for you to take up the demand given semiconductor supply?
I would say it's improved a little bit, but still I would say maybe now we are meeting close to 90% of demand. The global electronic supply problems for some of these products, especially in high horsepower, they continue. We are trying to work around those, develop some alternates, etc., and that is what has led to the limited success of going from 85% of demand to 90% of demand. But supply chain teams have war rooms, and they are working with some of these global suppliers to try to get this under control. So it's getting better. Every quarter, as I'm speaking, it's getting better. But is the answer that no, we are able to supply everything that every order that we are getting? The answer is still no, and it's still uncertain how much time it will take to fix that. Certainly, that the fact that China has not bounced back as strongly as was expected has helped us. If China were to bounce back stronger in the future quarters, again, this situation is likely to worsen. So, not a very 100% happy kind of situation right now.
Great. Lastly, just on your gross margins, your longer-term range for your gross margins are in the mid-30s. Sometime back, you also expressed this ambition to go back to these gross margins. Is that plan still on in terms of your capability to achieve those gross margins?
Certainly it is our ambition as well as our attempt to try to get there. And when we were recently studying some of this, we found out that a big chunk of why we lost some of those big percentages of margin were because the change in schemes like MEIS and RODTAP, etc. Those have had a significant impact on companies like ours because we export such a large amount out of our companies. So we are looking at alternate ways to try to improve the margin, but it's not as straightforward as it appears. The work is on, and we will continue to try to improve the margins.
Thank you, and all the best, sir.
Thank you. We have our next question from the line of Renu Baid from IIFL. Please go ahead.
Yeah, good morning, and thank you for the opportunity, sir. My first question would be related to CPCB4. While you've mentioned that products are all in place, just want to understand from bookkeeping perspective, the SCRs which will be required for the gensets, they will be booked as revenues by CIL and supplied to GOEM, or they'll be directly sourcing it for the purpose of the genset supplies?
They will be sold by CIL.
Got it. Sure. So relatively gross margins on the SCR portions could be a bit softer since these would be sourced components from group entities, right?
Could you repeat that question again?
So the resultant gross margins on the SCR components will obviously be relatively softer than the engines, given that these are outsourced components for us.
Yes.
Got it. So second, while you did mention one of your conversations that, NCR has had this restriction on usage of CPCB old two engine profiles, but if we see similar notices by NGT has been issued in states like Kerala, Karnataka and Maharashtra. So this shift in the customers in these states, the existing users who are using CPCB2, if they've been asked to use retrofit kits to make them usable and compliance-proof. Are you seeing that uses of retrofit kits are increasing, or these customers themselves are now looking to shift to CPCB4-based engines, at least from these large states which are industrial and commercial driven in terms of the GDP growth?
So that's exactly the point very clearly made, Renu. So many of our customers there have been getting notices to say that either they need to buy these RECD kits or find alternate solutions. And there was no alternate solution other than selling them those kits. So the kit sales have been increasing. And now, whenever such a request comes, we will be recommending to those customers to just buy CPCB4 plus gensets. So those market segments will migrate to CPCB4 is what we see.
So to that extent, the demand for CPCB4 as a new genset would not just be the new demand or new build demand, but also replacement of the old engines to the new engines.
That's correct. But how much of that will happen is something to be seen and studied. So it's very difficult to predict that.
Understand. Second, if we see, while you have this time not mentioned anything clearly, can you share some comments in terms of within the industrial bucket and the export mix? How have region-wise growth been? And you highlighted Europe slowing down very sharply. So on the exports, are we worried that this 500 crores kind of run rate, we may get stuck here in this range, or there could be probability of drop in the volumes if the global markets turn out to be far more weak than what is being expected?
Yeah. So, as I mentioned, we are seeing that Asia Pac has certainly started to slow down and drop. Latin America is also starting to drop. Middle East is at least flat as of now. Europe has dropped quite a bit. Africa is flat, and North America has also dropped a little bit. And the China data center market has also softened as compared to where it was in the previous year. Looking at all of these variables, if we were to do nothing, that is just continue to sell in the way we have been selling right now, I would expect that the markets would start to decline a little bit. But what we are trying to do is trying to launch more products and trying to get more aggressive and trying to get back some share. So with all of those efforts, we hope to at least hold at the level where we have reached with a lot of work, and then try to pick that up as the market starts to recover.
So in the same background, if I just add a question, we were expecting some higher volume shifts coming in from the UK market. There was some long-term agreement signed and shareholders' approval also for higher related party transactions. Has that transition in terms of higher volume growth happened through, or we are seeing some lag because of weakness in demand in those regions?
Yeah, some of that has already started. Some of that to do with the machined components, etc. Also, so it started, and those parts of the factories are working pretty fully. So that all of that is going on.
So lastly, one more. While yesterday there was an announcement regarding the new JV between Cummins Inc. and Tata Motors for hydrogen-based ICE engines. Will Cummins India, the listed company, have any role in terms of any supply chain part component being serviced to this JV, or any relevance of this development to Cummins India portfolio?
Yes, this JV is mainly related to mobility in vehicles. It was something which Tata Cummins was already doing. So this JV is formed with Tata Motors to launch fuel cells and internal combustion engines, utilizing the assets which are already there in the JV and making some incremental investments in batteries, etc. So certainly Cummins India could benefit from that, and that is the same kinds of products are used by Cummins India in its applications of power gen or industrial or rail, etc. We could buy those products at good transfer pricing, but it's not directly related to the Cummins India business.
Got it. Sure, sir. Thanks much. I have a couple of more. I'll get back in the queue. Thank you and all the best.
Thank you.
Thank you. We have our next question from the line of Nitin Arora from Axis Mutual Fund. Please go ahead.
Thanks, sir. Mostly my questions have been answered. Just one on your this double-digit growth guidance for the domestic market. Is it possible to attribute this is you're taking into account the decline in exports? Is that the right way to look at it?
Yes.
And this double-digit, I'm assuming double-digit can be anything, but generally that double-digit, is it possible to talk about how much would be attributed to volume, because your pricing is quite high given the mix of both the emissions?
Yeah, I think when we indicated double-digit, where the foundation of that is coming from, that we expect to grow at 2x of GDP. So if our GDP is growing at 5.5 to 6%, 2x of that is where we expect to keep growing our business. And it's difficult to comment on volumes because it's different for different market segments, but volume does grow proportionately. So it may not grow. It may not grow at 2x of GDP at that growth rate, but certainly we do. It's not in every cycle that one can get incremental price from the market. So certainly a bigger chunk of the growth comes from volume rather than just from price increases.
Got it. Thank you very much, sir.
Thank you. We have our next question from the line of Rahul Gajre from Haitong Securities. Please go ahead.
Good morning, gentlemen. I just had one question left. This move of, extending the implementation of CPCB4, this will ensure that the company is saddled with CPC, the inventory for a longer time, or do you think these orders or the manufacturing that you've done, they are against firm orders that the company would have got?
The manufacturing will be done against firm orders. So back to back, whatever are the orders which are booked and in the pipeline, they will be produced. But we don't see any risk of inventory during this cycle, because some of these products are also sold in other markets, in exports, etc. So as of now, we are not foreseeing any form of inventory risk.
So my second question is on the group announcement, where they're talking about investing $1 billion in India. Now, you have indicated where they are looking at spending this money. But, the listed entity, CIL, is planning to invest almost 300 to 400 odd crore rupees. Which are the specific areas that CIL is planning to invest this money, and what is the kind of time duration that we are looking at over here?
Most of CIL investments are in introducing new products to enter into new segments, whether it be rail, whether it be into mining, into marine, for our exports products, getting into battery-based systems. So most of the investment for CIL is mainly for growth projects. And limited amount is for, sustenance capex, as we call it, where we are refurbishing older buildings. Some buildings are 50, 60 years old, so, they have to be pretty much torn down and rebuilt again. So some of those kinds of investments are also required moving forward. And we're also upgrading a whole bunch of factories to use better technology, use Internet of Things, use a whole bunch of, modern manufacturing methodology. So it's a combination of those areas. And then as we get into areas like rail, fuel cells, etc., those areas will also need some investments in the technology, in the development of the technology, in the execution of the technology. So those are the areas where I think the listed entity will spend most of its investment monies on in the future.
So it's fair to expect that 1/3 of this Cummins Group investment will be in the listed entity. Is that the right way to look at it?
It's very difficult to exactly pinpoint that and say is that. But certainly, the Cummins India is a cash-rich company, and there is money on the balance sheet, so it is able to fund whatever investment it needs to help it grow. And our objective here is to try to get growth for the business. And so, whatever investments that the company needs to make to get that growth, I think we have all the resources to be able to do that, and we want to do it prudently.
Thank you very much, and all the best.
Thank you. We have our next question from the line of Bhavin Vitlani from SBI Mutual Fund. Please go ahead.
Yes, thank you for the opportunity. So, Ashwin, the question is regarding the voting resolutions on related parties, and wherein we observe a significant increase in purchases from CPIPL and Tata Cummins. And we do understand about the new regulations regarding the increase in the content. So if you could just help us break that increase into what is the volume assumption that we would have penciled in, and what is the increase in the cost because of the newer content that is required in that engine.
Yeah. So Bhavin, I can't break it down exactly, but I can tell you this, that the main supplier for some of our power gen products as well as for most of our industrial products in the construction market come from Tata Cummins. And as we migrate to CPCB 4 Plus and some of these newer technologies, the emission solutions which were never part of CIL purchases also come through CTIPL. So those, I would say, are the biggest reasons. And the construction market is starting to heat up and become better. The power generation, we had record sales, and so the purchases from those entities are in line with that increase in demand by the main company.
Okay, because sorry to harp, because on CTIPL from 700 crores to little over 1,400 crores, and in Tata Cummins from 1,800 crores to about 1,850 crores. So 100% increase, 50% increase. So the quantum was pretty significant. And if we total all of this, it was almost equivalent to the top line of the company. So the quantum, the sheer quantum was too large.
Right. No, it's a fair point. It's just that as the technology changes, some of these technologies are made in those companies, and we use the best technology available in the market, and these companies happen to have that best technology. So it's appropriate that when you go from no CPCB, no emission treatment to 100% emission treatment, that business goes up by 100%. So that's the logic behind why that has increased.
Okay. And what would be the end product increase? Would it be like 40% plus?
It's like we mentioned, right? It's anywhere from 20 to 50% is the end product of the genset. The prices have gone up.
Okay. The second, this was an observation for last year where we saw a deceleration in the sales of construction segment within the industrial. And correct me if I'm wrong, if I'm reading too much, because we saw Weichai starting and the share of the Chinese construction manufacturers growing. So is it that they are using the Weichai engines and consequently Cummins and the Indian companies are losing share?
Certainly, there are companies from China have been selling in India and have increased their share in India. And certainly, as the market leader, we get most impacted by that kind of inroads that the Chinese companies make. But overall, when we look at our industrial business market share, we have been able to hold on to our market share. You can argue that we should have gained market share, and we have not been able to do that. But we have held on to market share. But I am certainly seeing a lot more activity from China-based companies in India.
Okay. Just the last bit, within the industrial, we saw a very significant jump in the marine part of the sales last year. Could you just help us understand, was it some large order that, because the jump was exponential?
Yeah, one is we've launched a few products, and second is that we have also gotten back some share in the fishing trawler kind of market where we had to develop some new products there. And that market was primarily catered to by Chinese manufacturers. So we have managed to get some share back in that space. So I think there are more opportunities there, and we look forward to do even better in that space.
Okay, great. And could you give us lastly the outlook on the compressor side? Because that's been very volatile, and as you said, there's a lot of cyclicality there.
I think it's bottomed out and starting to, at least come back a little bit. There is a lot of cyclicality in that market, depends on monsoons, depends on government spending grants. There are too many variables there to be able to very accurately predict it. But I can say that Q4 was probably the bottom there, and it's now looking like it's starting to pick back up a little bit, though it's not at its peak yet, but it's at least it's up from where it was from a bottom perspective.
Sure. Great. Thanks so much for taking my question.
Thank you. We have a next question from the line of Puneet from HSBC. Please go ahead.
Thank you so much for the opportunity. My question is, you've also talked about the genset demand on the gas compression engine. How big is that market, and what is the share of those gas compression engines in your power gen demand?
As of now, it's very low. It's less than 5%, primarily because gas is not available. So this has always been, the bogeyman in India for the last, I would say now, more than 15 years, that gas is coming. And we have product, but gas prioritization for these applications is very, very low. So customers are not able to buy gas. So we do not see, at least for the next 3 or 4 years, till that supply chain is sorted out by the government, that this market for gas is going to be anything exciting.
And in terms of your CPCB4 engines, what is the extent of localization that you've been able to achieve?
We are already greater than 80%, but we will continue the work to get to greater than 90%, which is our traditional average. There are many of in the last 10% is almost impossible to do right now, because they all have to do with electronics and some of those kinds of parts which are not made in India at all.
Okay. So in terms of margins, how should we think about these CPCB4 products? As the share goes up, should we be looking at lower gross margins, or would you still be able to maintain 32% to 30%?
I think we are trying to maintain or increase the margin. That's been our attempt, with better products, with better technology, with better features and capability. But we do not anticipate any reductions in margins with CPCB4. We think we should be able to improve the margin.
Okay, that's very helpful. Thank you so much, and all the best.
Thank you. Ladies and gentlemen, please note we'll be taking the last 2 questions now. We'll take our next question from the line of Pulkit Patni from Goldman Sachs. Please go ahead.
Sir, thank you for taking my question. Given that we'll have to, produce and maintain inventory of both CPCB 2 and 4, is it fair to assume that for the next, few months, maybe a couple of quarters, general inventory levels for us of, raw material, of parts, etc., will increase, or is that not going to be the case?
That is already the case because of the pre-buy, that there is additional inventory in the channel. So certainly inventory levels for the next 2 quarters are likely to be higher than the historical average. But this typically happens at every transition cycle, and so we will bring it back to a regular, optimized level after a couple of quarters.
Understood, sir. And maybe just a related question. So we will be producing the CPCB2 engines up till what, 4th quarter, or it'll be 3rd quarter, because after that this goes away?
Yeah, so most likely we will attempt to. Right now, it's all based on booked orders. So since we already have the booked orders, there is absolute clarity on what can be produced. So we will attempt to wrap up the CPCB2 at least 1 quarter before the deadline, and then build all of that into inventory, and then get our focus 100% on CPCB4+.
Okay, understood. Thank you.
Thank you. We have our next question from the line of Amit Mahawar from UBS. Please go ahead.
Thank you. Ashwat, I just have 2 questions. First is, so in FY24, what percentage of our power gen revenue will be, effectively CPCB4 4 Plus products, since you already have the clarity and booked orders? That's first.
The answer to that is we think about anywhere from 15 to 20% is likely to be, 15 to 25% is likely to be CPCB 4 Plus at this stage.
Fair. And in your sourcing for CPCB 4 Plus products like SCR, etc., from Cummins entities, what percentage of that sourcing of the bill of material will be from Cummins entities versus, say, CPCB 2 compliant engines?
I think the only incremental component from Cummins compared to CPCB 2 is the emission treatment system. That's it. There's no other component which comes from Cummins.
Incremental. Thank you. The third and last question quickly, sir, is so yesterday in parent results, they've done very well on results, but they've not increased the guidance, which basically does it imply that exports for Cummins India, in second half this year and maybe, initial part of next year might still be weak in terms of run rate that we've seen in last 2 quarters? That's it, sir.
Yeah, and I think that's, as I explained earlier, we see some softening in the global market, and which is why we maintain that we will, the overall business, we will continue to grow it at 2x of GDP, and we will try to make up any shortfall we are seeing in exports. We'll try to make it up in the domestic business, but that does not mean that we are not pushing very aggressively to try to get more business out of exports as well. But based on the visibility that is available today and based on all this, the global market being slightly uncertain, that's the best guidance we have. But certainly our optimistic internal scenarios push us to do better than what they're indicating right now.
Thank you, Ashok, for realistic commentary, and thank you very much and good luck.
Thank you.
We'll take a last question from the line of Amit Anwani from Prabhudas Lilladher. Please go ahead.
Hi, so thanks for taking my question. My question is related to, we have been highlighting about the supply chain issue, and I think till a couple of quarters back, we lost on volumes also because of the shortage of supply chain. Any color you would like to throw on the situation right now and going ahead?
Yeah. So despite supply chain problems, supply chain has been improving quarter on quarter. If you look at the last, almost 12 quarters. Now, of course, our aspirations are greater, and we are pushing more product. We are trying to get market share. So all of those things mean that the pressure on the supply chain is even more. So even though they are doing better every quarter, our demand on them is even more. So where we are today is that there are already a lot of investments that have been made, which take anywhere from 18 to 24 months to get ready. So some of those are already in the pipeline. We have enhanced capacity quite significantly with multiple suppliers. Our factories are running at 100% of the manned capacity. So we are trying to do everything possible to try to keep getting better at delivering what demand is out there in the market. And I remain confident that despite all these challenges, we will continue to, inch our way towards even better delivery of product.
Right. So next question on the domestic side. So we saw the robust revenue because of the pre-buying. Would you like to share on which user segments contributed significantly, and how was the data center contribution and growth, if at all, this quarter?
Sorry. Some noise there. Okay. We don't have a complete set.
Ladies and gentlemen, we've lost the connection of the management line. Request you to stay connected while we rejoin them. Ladies and gentlemen, please welcome the management team back on call. So please go ahead.
Yeah. So I was responding to the question about what's the breakup by segments, and what I'm saying is that the traditional segments of data center, of realty, of pharmaceuticals, of manufacturing, of hospitality, pretty much across the board we are seeing good demand in the power gen segments. But the breakup for the previous quarter is as following. Low horsepower was 103 crores, mid-range was 273 crores, heavy duty was 111 crores, and high horsepower was 387 crores. So, pretty good demand out there.
Mr. Anwani, does that answer your question? Mr. Amit Anwani? His line is disconnected, sir. Please go ahead.
So, I'd now like to make my closing comments. Thank you for your participation and active engagement today. As always, you guys ask amazing questions and tough ones. Cummins India believes that the strong demand in various end markets will sustain. However, because of supply chain complexity which we continue to work through, we remain cautiously optimistic about the short to medium term demand outlook. With a strong balance sheet, world-class infrastructure powered by manufacturing excellence and outstanding talent, we are confident of sustaining our growth trajectory. With this, I close this call. Have a great day and stay safe. Thank you.
Thank you. On behalf of Cummins India Limited and the leadership team, we would like to thank you for joining us today and making it an engaging session. We're ending the conference now, and you may now disconnect your lines.